Hey everyone, this is Rob Keens with goldsilverpros.com. It is Thursday, February 25th, 2021, and today is a very special day because tomorrow we have the first intent day for physical deliveries on the Comex for silver. We're going to preview that and show you what may happen starting tomorrow. Will we have fireworks in that market with physical deliveries? Well, wait and see. We're also going to talk about inflation. Somebody in the last presentation earlier this week when I did the live stream was asking me to show them the inflation. So I'm going to show you the inflation, and that's going to lead off into discussion about the next commodity super cycle, which I think is going to be a very interesting presentation for you guys today. So we'll go ahead and get started with the presentation. We're going to start off with an article here at Zero Hedge. Treasury Secretary Yellen talking about higher corporate taxes, yield curve control, and a digital dollar. These are all things that I've been talking about for a long time. None of this whatsoever surprises me. She's talking about a 28% corporate tax rate to pay for Biden's longer-term economic reconstruction program. I don't know what the hell economic reconstruction means. If they're trying to advocate and say because of the shutdowns, we need to rebuild the economy. Yeah, sure, that's fine. You don't do that through taxation. You do that through actually lowering taxes, providing economic incentives to small businesses, because they're the ones, after all, that create the new jobs and create the innovation in an economy. And you don't do it by raising taxes on the corporates, but that's what they're going to do. And fine. I don't expect to have a lot of economic growth. We'll watch the GDP going forward. And I think those numbers will prove out, not only because of the higher taxes, but for a lot of other reasons, all the debt that we have sloshing around in the system. Eventually, you have to pay the piper there. And I think we're closer to that than not. So I think it's a dream that raising taxes 20% is going to do anything other than further the decline of the economy. Yield curve control, basically talking about this article, controlling the yield curve, meaning the 10-year, 2-year Treasury and the relationship to one another, and also trying to control the amount of inflation we see in the bond rates, the raises in the bond rates, because we've seen bond rates go up. And I'll show you that in a moment. They're also talking about the digital dollar. And this is highlighted in bold, and I want to highlight it as well. Perhaps most notable was Yellen's reaffirmation that it makes sense for the Fed to look into the idea of a digital dollar. So I've already said that most of the world's central banks, 50 central banks, have already come out in favor of having digital dollar, digital euro, digital yuan, digital yen, digital pound, digital currencies, and getting rid of cash. Of course, we've talked extensively, I don't know how many times, about the position paper that the IMF put out in 2015 and getting rid of cash, implementing negative interest rates in the banking system, not in the bonds, but in the banking system, and then going to a full digital system and then direct payments to people. And I think this is, again, Yellen as Treasury Secretary seems to be in favor of that. Maybe they'll merge the Fed and the Treasury. We've heard that as a potential rumor, or maybe everybody would just be accommodative getting rid of cash. And essentially, the central bank and the Treasury will be one, even though they will have different figureheads leading them. So interesting news. I've been talking about this for months. People have criticized me for saying we're not going to go cashless. We're not going to go to digital currencies, national currencies. I say hogwash because it's been all over the news, in public, reputable sites, on the IMF's website. The BIS has come out in favor. Most of the central banks have come out in favor, and Yellen's the Treasury Secretary is saying she's in favor. I don't see anything to stop them. Of course, it'll probably be the destruction of the current dollar before they fully roll out the digital infrastructure, but it's already underway. The digital infrastructure is already in the commercial banking system, the credit union system. FedNow is the Fed's direct payments to consumer system. So all of that infrastructure, that plumbing, if you will, has been put into place. No surprise there. Let's move over to the 10-year Treasury rate. As you can see, I've got it here on a 1-year chart. You've seen it rise, especially since the shutdowns last year, where it fell to about 0.6, 0.7 range. Now it's double that at 1.51. And the second article here on Yahoo Finance basically sets the stage for us. It says, inflation bets, poor auction sends yields up new milestones, meaning they're having a hard time selling the debt, specifically the 7-year Treasury. We'll show you that here in a moment. But also people expect higher inflation, and so do I. And that's going to get us into the inflation conversation here in just a moment. Let's read this article. This is according to Ross Herbert from Reuters, reprinted here at Yahoo Finance. U.S. Treasury yields rose to new milestone highs on Thursday as the week's sell-off in bonds on rising inflation fears continued, accelerated by a disappointing auction of 7-year notes at midday. The 10-year yield was up 11.9 basis points at 1.5078. It's higher now at 1.518, higher than when the article was written, and touched as high as 1.614, the highest in a year. A big move came in the early afternoon when an auction for $62 billion of 7-year notes by the U.S. Treasury showed poor demand, with a bid-to-cover ratio at 2.04, the lowest on record, according to a note from DRW trading market strategist Lou Bryan, who called the result terrible. So they're trying to auction off some bonds, and they called it terrible. In fact, the bid-to-cover ratio was the worst on record. People are not demanding bonds, and therefore rates are going up. Therefore, if you have an older bond with a lower rate, your price is going to come down because your yield is lower. Remember, yields and prices are inverted. This is going to hurt existing bond holders. It's also going to hurt the U.S. government, which has to pay more for new bonds. It's going to raise their cost of financing the debt, in other words. And then you have them raising taxes on corporates. Those both go against economic growth. The trading also pushed up a closely watched part of the U.S. Treasury yield curve, measuring the gap between yields on 2- and 10-year Treasury notes, which we mentioned a few minutes ago, seen as an indicator of economic expectations. It went as wide as 141 basis points, the most since 2015, and was last 134 basis points, 9 more than Wednesday's close. Other parts of the yield curve also steepened. So we've got a steepening yield curve, which lessens the potential for a near-term recession. However, we're only talking about 134 basis points. That's not much. Remember, the yield curve briefly inverted back in 2018, I believe it was, just briefly, which is an indicator of an oncoming recession. Of course, there was more easing, and so it's widened out, but it's not very wide overall. So it doesn't mean that we couldn't have an inverted yield curve and then eventually head into a recession, because there's not much space there overall. So again, Treasury rates going up, not a good sign for the government, not a good sign for existing bondholders, because of expectation of higher inflation on rising inflation fears, according to the experts in the economy. So where is the inflation, Rob? Let's get into that discussion. I like to follow shadow government statistics. The gentleman that's been doing this, John Williams, has been doing this for a long time. He's an old school economist. All he does is use the government's own methodology to print what the actual inflation rate is. Now he goes back to the 80s so that you can compare inflation rates today versus inflation back in the 80s. So in other words, he's not making up his own schema. He's saying they've changed the inflation indicator along with a lot of other government statistical indicators over the years. You can't compare one to the other. If you want to compare period to period, you got to go back to the old system. So he goes back to the old system, uses that rate, and produces his alternate. You can see here on the screen for consumer inflation. So the official CPI is down here in red, and then the SGS, the shadow stats, is up here, or the real one. It's hovering about 6% now. That is on the 1990 based alternate. Now, there's a 1980, 1990 because there's two big changes to the inflation rate since the 80s, once in the 80s and once in the 90s. And then, of course, there's ongoing manipulation, hedonics, geometric weighting, things like that I explain in chapter 2 of my book. Spend 50 pages explaining this and why I don't believe the government numbers because of all this. In any case, it gives a 1990 measurement, you'd be closer to about 5.5%, 6%. And then if you use a 1980s measurement, you're sitting closer to 10%. So that's inflation when measured on historical measures. And that's important because if you want to compare 1980s, 90s to now, 2020s, and if you want to compare it to back during the Great Depression, if you want to compare it to the 50s and 60s, that's what you have to do to compare apples to apples. And that's a much higher inflation rate than they report through the official government numbers. Of course, anybody that goes to the grocery store and looks at the price of milk understands this. And I will say, I just basically went out and had some wings at a popular wings restaurant for lunch here today. I bought some wings. The wings were both smaller than I'd ever seen them at this restaurant, about 2/3 of the size of the normal size of wings. And the price for the wings, not a combo, just the straight out wings itself had gone up about 20%. And this is since 2 weeks ago, the last time I went to the restaurant. So smaller product, higher price. We're also seeing that at the grocery store. We're seeing higher milk and egg prices. We're seeing higher prices for car. I just recently got a new truck. The price was exorbitant. It was twice what I paid 7 years ago for basically the same model of truck, almost exactly the same model, twice the price. So that, we're seeing inflation everywhere. You look at the college tuition rates, look at energy prices. There's inflation all over the place. And we're going to look at crude oil here. You see that crude oil has gone up now. It's about 63.40. Of course, last year we were looking at a low of about 25 or so. At one point, the crude oil futures went below zero. They went negative just temporarily because of the shutdowns and the expectations for future energy demand. Of course, it's that's just the futures market. You couldn't actually get a barrel of oil and money back for free. It's just a futures, but the futures have gone up into the $63, $64 range. We're starting to see inflation hit one of the main energy commodities. Of course, I've showed you in past presentations how natural gas has spiked up and a lot of the other energy products has spiked up. The overall commodity index is coming up. So there are signs that more inflation is on the way. And I'm going to show you a chart here in a minute to show that commodity inflation is going to explode when you look at historical means when compared to the stock market. We'll show you that here in a moment. I wanted to show you the Bloomberg commodity index. You can see that from the shutdowns last year, it came down to about 130 print. Now it's up at 180 print. I showed this maybe about a month ago and showed that it had recovered from where we had started 2020. Now it's above where it started 2020. So we're a year later, about 13 months later, we're higher on the commodity index measure, the Bloomberg measure, than we were about a year ago. So that's a sign of inflation. Why? Because commodities go into everything that we use. When you're eating something or using energy or using a product, that commodity bids up the prices. So it's going to hit consumers. That's why it's important to follow these indexes. If we go out to the 5-year, we're actually sitting almost where we were in the peak of 2018. So we're almost at the highest rate in the last 5 years of the Bloomberg commodity index total return. And look at the recovery since the shutdowns. Here were the shutdowns, and here's the recovery. We've now surpassed where we were during the shutdowns at the beginning of 2020. And then we're almost as high. This is a 186 print from back on, it looks like May 25th of 2018. We're almost back to where we were in 2018, which is a previous high. And then you can see it falls off. So in other words, we're almost at the all-time high of where, in fact, we're about 4 points off the total high since Bloomberg started this commodity index return, which covers the last 5 years. So there's your inflation. And again, we've recovered since the shutdowns and we've gone past that. That's a sign of year over year inflation, not just inflation since the deflationary effects of the shutdown, but inflation over when measured against the last 5 years. You would expect, therefore, the prices of consumer goods to continue to come up. Now, if you think about all the jobs lost, the stagnation in wages, the lack of overall growth of incomes for the last 30 to 40 years, this is going to hit consumers. There's your inflation. But wait, there's more. Let's get further into it. Here's a nice little chart from an article at Zero Hedge. I'm going to show you the article. It's called The Next Commodity Super Cycle. It's printed Sunday, February 21st, 2021. I'm sorry. I'll slow down my speech here. And then this is the only chart that I really care about in this article. The rest of it's great. Thank you, Variant Perception, for providing this to Zero Hedge. But this is a ratio of commodities to the S&P. And since this is measured since 1970, 50 years, we're at our lowest print. It means that the commodities relative to the S&P stock market index are at a 50-year low. 50-year low. That means we're at an extreme. What happens when these measures go to an extreme in the financial economy? They tend to revert back to the mean. What is the mean? About a 3.8 print. Okay, so that would be along the lines of what we saw in 2010, of what we saw in 2003, of what we saw late 1990s. Okay, that would be the mean, but usually when they revert from the mean, they go above that. Look at this, goes above. You have above the mean, down to the mean, above, down to the mean, above. And the further down below the mean you go, the bigger the pop back up. So this is the lowest it's been in 50 years. The pop back up is going to go probably somewhere in the 8 to 9 to 10 range on this ratio. So a couple of things would have to happen there. Crash in the stock market, increase in the cost of goods. That's what's pretending longer term inflation for the average consumer. where it matters, when you have to buy something to support your family, your food, your energy, things also that go into make housing. Housing will get more expensive because you think about wood, oil, which goes into shingles, metal like copper. We've seen copper at more than a 7-year high. I think it's almost a 10-year high. Copper reached over $4. That's where you're seeing the inflation. The inflation is there. And again, go back to the alternative measure. If we use the historic government method dating back to 1980, we're seeing about 10%. And we've seen that dating back to 2000. I mean, the inflation has gone above 5% since 1991. So about 30 years, it's been above the government numbers. When you use the old government measure, if you want to compare apples to apples, you have to. You cannot compare today's CPI versus the old inflation measures. It does not work. So that's the evidence that I'm showing you in these charts. And we're about to go in a commodity super cycle, meaning the prices of things that we use every day are about to shoot up. And when I say about, relatively speaking, it's probably in the next several months to a year, because look at what happens. It reaches a bottom, and then it doesn't take that long. In a year to year and a half, it starts to shoot back up, and it usually, boomerangs way past the mean, and then eventually comes back down. And that whole process generally takes somewhere around 10 years. You can see it's about 10 years, 10 to 15 years every time that process occurs. So for about 6 to 7 of those years, we're going to have much higher prices than the mean on commodities that we use every day. That's what's to expect. And so from an investment perspective, if you want to try to offset some of those losses, you go into commodities. Of course, we talk about the precious metals all the time. Silver is used in a ridiculous amount of industries: medicine, jewelry, energy, solar, electric vehicles, just all over the place. Electronic items like iPhones, for example, my iPhone. It's get used in everything. Gold's also used in electrical components on computer motherboards, so on and so forth. But there are other commodities as well. The energy commodities, the food commodities are all going to come up. The whole commodities complex is going to go up. So not only are we having inflation now, if you look at existing in terms of the last 5 years, when we get to this commodity super cycle, revert to mean, and then shoot past that mean, you're going to see prices continue to rise. So there's your inflation right there. Person asked it on the last video. I delivered it to you. There are the measures for you. Now I wanted, as I promised, to get into talking about what's going to happen with silver deliveries. Tomorrow is the first notice of intent date for the March contract. We'll explain how all of that works here in the next few minutes. First, I wanted to look at the month-to-date deliveries. This is a printout today as of like noon Eastern time, I believe. And so far for February 2021, this is the gold. I'm going to talk about gold here for a second. We've had 34,000 contracts of 100-ounce gold delivered. It's actually a very high number. The last time we saw that was late summer. So gold is actually, February was a very big delivery month, and there was a fair amount of open interest, but it was a lot bigger than December. And that's really gone unnoticed. Nobody's talking about how many physical deliveries there were on gold. There was a ton on the Comex in February. People are getting their gold, I think, in anticipation of potential shortages and anticipation of what we've been talking about: higher bond rates, trouble in the bond sector, potentially a stock market crash, and higher commodity rates. In other words, inflation, potential bond collapse, potential banking issues, and potential inflation. People are getting their gold. And it's very clear. You can see that on Comex. We're going to go down here to the silver. Now on silver, it wasn't that big. You ended up February with about 2,404 contracts of 5,000 ounce silver. That's a fair amount. It's been bigger in February. It was in previous months, especially since February wasn't huge open. I mean, there was a fair amount of open interest, but there's a fair amount of silver delivery. So are we going to see more or less than 2,404? Let's look and see how this works. So we're going to go over here to the silver futures. As of right now, there were 12 as of Wednesday's data. So yesterday's data. And we don't have today's data yet because the market is just about to close and they won't have printed the data yet. But yesterday, Wednesday, we saw 12,249 contracts either settle in cash or for deliveries. There weren't a lot of deliveries, only 15. So mostly for cash, or they rolled to a future month. About 12,122 of them we expect to have rolled to May. There's a few that rolled to April, so on and so forth. So the majority of contracts that came off the March silver contract went into futures months. So what does that leave? As of right now, before the market close, or right at market close, we've got 16,093 contracts of 5,000 ounce silver. Would that be enough if they all stood for delivery? Because anything that rolls at the close of business today, Thursday, February 25th, would be standing for delivery. It would be the first intent date on the March contract to stand for delivery. So is that enough contracts? 16,093. If we go to our calculator, let me stop sharing on this screen and get over to my calc. I've calculated that we could have a potential for 80 million ounces, as you see here. 16,093 contracts times 5,000 ounce silver is 80 million ounces potentially to stand for delivery that where they did not roll their contract. And so let's get over to what the physical inventories are. If you look at the spreadsheet from the CME Group printed today for amount of silver ounces in the registered category, that's what could be delivered. They have 135 million. So we're not going to see a bankrupting or a run on Comex in silver today because we got more supposedly available ounces than the amount of contracts of 5,000 ounce silver. Plus, I expect some more to be rolled today. That number will print tomorrow. It's going to be a day behind, so I don't expect there to still be that many contracts basically standing for delivery. So I expect that we're not going to have a run on the Comex. Of course, on Monday, I told you why you can't really run the Comex because of the way they can force you to settle in cash. To keep the market integrity, they can punch you off the exchange. They can force you to roll your contract. They can force you to settle for cash. They can stop trading. They can do whatever they want. It's codified into law. This is not conspiracy theory. It's in 40.1H. You can see that on Cornell Law Library. I showed you that on the previous live stream I did earlier this week. Go watch that live stream if you want to see how that works. I don't think there can ever be a run on Comex, not a traditional forced metal run, although we could see a lot of delivery here potentially for the March contract. We'll have to see what happens. Again, as of right now, there's 16,093. That's 80 million ounces. Depending on what comes off today, which will show in tomorrow's print. Again, this is today's data. You could roll all 16,093 and maybe there's none left in March, or there's probably going to be some. And somebody could come in and initiate a March contract in March if they wanted to. Let's go look at the calendar. So how this works is the first notice day for March is the 26th of February. That's tomorrow. Of course, you can still put in a contract during the month and then and basically come in and stand for delivery. Not sure that you're going to get it, but it's possible. So additional people could come in, but there's not going to be a run. We could see more metal delivered on the Comex, more than the 2,404 contracts, higher than it was in February. That's entirely possible. I mean, there's a fair amount of open interest here, that could result in some deliveries. I just don't expect it to be too wild. I think a lot of it's going to be pushed off into the EFPs, which is the exposure to the unallocated silver on the London market. Wednesday, they had 335 on the March contract. If you go back a couple of days, 728 here for Tuesday's numbers. Monday had a large print at 1412. February had a large print 2105. All of these numbers are higher than the actual deliveries on Comex. So a lot of this demand for physical or exposure to an OTC silver physical derivative, is being pushed off into that OTC market. It's not being delivered on Comex. So I don't expect a whole bunch of deliveries on Comex. We could beat this number. They're not going to run it. And again, Monday's video, I said you can't by law run the Comex anyway. You can delegitimize it by getting your own physical, taking delivery of your own physical as a retail investor. And if the sovereigns come in and gobble up all the 1,000 ounce bars wherever they can get them, regardless if it's on Comex or not, that could still cause a silver physical run. And then if Comex couldn't deliver any standing for delivery, or they announced we're never going to deliver again, or at least for this month, I think it would, to some extent, delegitimize Comex in a lot of people's eyes because they're not delivering physical, and therefore it has no tie whatsoever to physical. So is it just a legitimate hedging market, or is it just a speculative market? I think it would become a pure speculative market at that point, and I think you would see trade start to go east. I think you see it go to the Shanghai. Maybe you start to see physical markets pop up elsewhere. So you could delegitimize Comex even if you can't run it out of metal and shut it down. But I think you could delegitimize it in the eyes of a lot of the traders. We'll see what happens. I don't know if that's going to happen next month. There's just not enough really standing. I mean, if you look back last Friday, there were 58,000 contracts open at close. Now there's 16,000 people are rolling or settling for cash. I mean, that's what's happening. So I don't think you're going to do it this month, but it'll be interesting to see if we keep up the physical demand pressure. eventually it's going to come back to the Comex. It's going to be a second order effect on the Comex when they have no physical. I think we're a ways away again, because they say they have 130 something million ounces on registered category, if you believe that number. And a lot of the demand, as we see this month, we'll go back to Monday's numbers, and last Friday's numbers are actually rolling to the unallocated OTC market exposure over there in London. See that as you're seeing all the numbers here, you see more in London, which is here, than you're seeing on the Comex. So that's been a fairly consistent trend since 2021 began, by the way, and it's occurred both in silver and in gold. Now, the interesting thing, when I went to see the daily delivery notices for today, there's nothing there. So they haven't printed it yet. I want to see what the delivery notices were for the 25th, which is today, because according to metal issues and stops report, we only have through basically yesterday's data. Today has not printed yet. We'll see what happens when they actually run this information. Now, typically on the daily, they'll print a number, or in others, when you run the daily on the website, they'll print whatever date has value. So I was expecting 224 to pop up, but they gave us 225, and none of the data, silver, gold, copper, none of it's here. It's really weird that they would do that. Anyway, I think it's probably just a glitch in the system. And that is basically it, ladies and gentlemen. That's how that system works. I don't think we're going to see a run on the Comex, but if you continue the physical pressure, you know, the Wall Street, silver, the Redditors, all of the people have been talking about the undervalue of silver for so long. Eventually what happens is you have a squeeze on actual physical when you need it. The derivatives start looking illegitimate. People start moving over to more physical trades. We've seen it from people going from SLV, going over to PSLV, people going to the retail dealers. I think people may go to the Shanghai market. You'll see that occur. And I think people are starting to really take, you know, delivery of their silver and gold. We saw 34,000 contracts delivered on Comex and gold, more gold liquidity. So Comex, I think, is still allowing deliveries, and there's enough liquidity there for people to deliver. But I think people are going into gold now ahead of what? Ahead of that inflation. We see the inflation start to creep into the bond rates. In other words, people aren't buying the bonds anymore. So that bond system is becoming more unstable, which means we may have trouble there. And we see inflation coming to prices, the commodities prices, which I showed you, the Bloomberg index, the oil index. Previously, I've shown you natural gas and naphtha and all those other energies. And we're at the bottom of the commodity super cycle, the very bottom, the lowest bottom in something like 50 years or whatever the measurement was. So the next reversion back to the mean and shooting through the mean means commodity prices are about to shoot really higher in the next year or so. Next year to 18 months, we'll put it, according to that chart. If that chart, you know, backward looking chart is an indicator of future cycles, which why wouldn't it be? It's got a 50-year history to it. We're about to see an explosion, a big explosion in commodity prices. You'll see inflation tick up much, much higher. Of course, we know that can occur because you've seen M0 and M1 prints of the Fed. I printed on the channel many times where it's gone vertical. I think 40% of all liquid cash has been produced in the last year, dating back to 1913. So 1913 to 2020, you had 60% of all physical cash produced. And then last year, 40%. So the money in circulation has hockey sticked. It's hyperinflated. And eventually that's going to make its way to prices. And all of these indicators we're talking about, that the commodities are going to continue to rise. We're in a massive commodity bull market, massive price inflation for consumers. And again, people have already, I think, gotten most of the liquid silver off the market, holding for higher prices, and they started to move into gold. That's why we saw those 34,000 contracts in February in gold. So any case, that's going to do it for today, guys. We'll come back later on with more. I might do a live stream next. We'll have to see what happens. But that's going to do it for us today. If you guys are interested in getting notices on these things coming out, if you're not getting them on YouTube, or you just want to be notified anytime we do new news, go to my website and click on that newsletter link. Of course, we also have a paid subscription. We do quarterlies there. We have Gold Silver Pros University. That's available on the website, goldsilverpros.com as well. Until next time, guys, this is Rob Keens at Gold Silver Pros.